Yeah, we are good. We're live. Great. Kia ora tato. Welcome back to another Q&A here at Digital Boost. I'm Georgia Hatzis, your host. I'm excited to have our Sam Harith back with us from Sam Harith Accountancy, and he is known as the comic accountant. If you've been with us with Digital Boost for a while, you absolutely know Sam. Sam comes in at the perfect time to feed us any kind of accounting information that we need. Today's a really good one. I think we're all noticing a little bit of maybe a heaviness or a turn in the air. It's not just the weather. It's not just a happy spring. But we're talking today about cash flow management in economic downturn. And any questions you might have, please pop them into the Q&A. If you're watching on our socials, put comments in. I'll keep an eye out for those. But Sam is going to take it away now. Sam, I love having you here. It's always fun. It's always good to see you.
Always
Thanks for
happy to be
coming.
here, Georgia. Always happy to help contribute to the Digital Boost team. I think you guys are doing a great work in helping small businesses in Aotearoa make it in this big, scary business world.
Yeah, it's such a great, I know. I mean, we talk about Digital Boost all the time and how much we love it. Digital Boost this past year, me being here, and you guys have heard me. Those of you who come here regularly know how much I absolutely love getting to help your businesses grow and bringing in people like Sam and the other wonderful guest presenters we have who come in. So, oh, and just quickly, Sam, I'll say to everybody, if you haven't seen the other Q&A sessions we've had with Sam, hop onto our platform. You can just put his name in and you'll see all the other beautiful wisdom he's had to share with us about his mahi. So thanks, Sam.
Hey, no problem. Always happy to help. And that's what I'm here for. Yeah. All right, cool. So let's kick off today's session. Kia ora, everyone. Tēnā koutou. And welcome to our webinar. Let me just share the screen. There we go. Right, so today we're going to be talking about managing cash flow in a declining market. Now, I think if you're a small business owner, you would have noticed that things are just kind of a little bit slow. I wouldn't say that we're in the doldrums, certainly not, but it does feel like things have kind of slowed down, even though we're no longer in a technical recession. But I think the overall business sentiment has sort of plummeted. A lot of our retail clients and hospitality clients have been telling me, they're saying, hey, Sam, I'm noticing that sales are dropping. I'm noticing that people aren't buying as much. Clients in construction firms are saying things like, hey, Sam, it's been really hard for us to land contracts, and people aren't wanting work to start until even next year. And so they've got to figure out how to get short-term bridging finance just to keep their staff paid over the short term. And so it's really tough for people out there. And I think it's further compounded by the fact that lots of people are losing their jobs. The recent round of government job cuts has definitely had a flow-on effect to the rest of the economy. And even private sector companies are looking at cutting off their staff. I've had a few personal friends of mine who've lost their jobs from construction and construction adjacent firms. Got a mate of mine who actually lost his sales position at one of the local ITMs here in Waikato. So yeah, tough times for everyone. The good news is that as a business owner, fortunately, our income isn't tied to the whims and fancies of our bosses, because we're kind of sort of our own boss, right? So with that being said, we still want to make sure that we can make a decent amount of money from our businesses. So how do we manage our cash flow in a declining market? All right. So first of all, let's start off with a saying. I've got a saying, my own personal saying. Profit is an idea, cash is reality. Okay, so you got to remember that first of all, profit does not equal to cash. All right. So that's going to be our first topic for today. We're going to look at cash versus profit, and we're going to talk about cash flow visibility. We're going to teach you some hacks to hack your working capital. All right. Going to teach you how to stay on top of your taxes, even when your cash flow is bad, because believe it or not, you still have to pay taxes, even if you're not making money. More on that later, right? And how to forecast your future cash flows. Okay. Right. So first of all, cash versus profit, also known as why you still have to pay taxes when you got no money. Haha. Right. Okay. Okay. So first of all, let's take a look. What is profit? Okay. So profit is a snapshot of income minus expenses over a set period of time. Okay. So that is what profit is. All right. So profit is what's left over after deducting your tax deductible expenses from your revenue. Okay. If there are more expenses than revenue, then you get a loss. And profit doesn't usually match with what is left in your bank account. Now, that's really, really crucial. Okay. Right. Because not everything that you spend through your business is tax deductible. Right. And now that's the biggest misconception that a lot of people have about their business. They're saying, like, oh, yeah, but I've spent money on my fuel and buying meals for myself and paying myself. Why aren't those tax deductible? Well, sorry, buddy, they're not all fully tax deductible. So that's why profit can always end up to be higher than the amount of cash you have left in your bank. All right. Now, some important things to know about profit. It's calculated on an accruals basis. Okay. Sales are recognized when you issue the invoice, not when it gets paid. All right. So if you're running a business on an invoice basis and you issue an invoice on the 30th of March, 2024 to your clients, and it's an invoice for $1,000, that $1,000 gets added to the financial year ending 31st March 2024's profit, even though your client doesn't pay until the 5th of April 2024. Okay. All right. Second, it's influenced by non-cash items. All right. So depreciation and asset revaluations and even asset sales can affect your profit, even though they don't impact your cash level. Okay. And it only represents a snapshot of your business. It represents your business at a moment in time. It only reflects profit over that particular period. And when it comes to taxes, we're only paying taxes based on the amount of profit that we made over a specific period of time, right? And so it's probably not the best way to reflect businesses' overall wealth, but it's what we got, and it's what we've been doing for the past 100+ years or so since accounting was invented by monks in the 14th century. Yeah, right. Cool. Next, let's take a look at cash. Now, what is cash? Cash is a means of exchanging value for products or services. Okay, very different from profit. Now, cash represents the currency that your business deals in. It is the most liquid form of asset you have. All right. Cash, let's take take an example of the old barter system that we used to have. Once upon a time, we used to trade goats for rice and rice for kumara and kumara for building materials, right? For example. But in today's modern world, we use cash as a means of representing value. Okay. So it is the most liquid form of asset you have because cash can be converted into literally anything that you can buy, right? So cash usually sits in your bank account, in your wallet, or under your mattress. Now, key characteristics of cash. Now, cash physically or digitally exists. Okay. If you've got balance in the bank accounts, then you got cash. All right. What you got in your bank account, that's your cash. You know, you can't take that away from you. That is immutable, right? Profit is malleable, I like to say. I mean, it's not like what I like to say officially, but ask any accountant and they'll tell you that how much do you want your profit to be? I mean, not at our firm, though. Certainly not at our firm. Right. Okay. All bank transactions are done in cash. Okay. So paying taxes, done in cash. Paying staff, cash. Paying suppliers, cash. Getting paid in cash. All right. Almost all business transactions are conducted in cash. You can't go up to your suppliers and say, like, hey there, supplier person, can I get, say, 10 kg of meat and in exchange, I'll cook for you for the next 2 months. Doesn't usually work that way, right? Okay. And cash can be increased or decreased without affecting profit. Now, this is really, really important to understand. You can increase your cash by putting money into the business. If you pump money into the business, you can increase your cash, all right? Or you can take out a loan, right? Which is debt finance. And you can also decrease cash by taking money out of the business or paying off a loan as well. And these things also don't affect your profit level, okay? Right? And it's quite interesting, really, because often, especially if you look at larger tech companies like Zero, for example, and we use Zero in as the main accounting software in our accounting firm. Zero, interestingly, is famous for having never turned a profit for almost the past 10 years. Hmm. Yeah. So you can actually go on and take a look at their financial investor statements. It's available to see on the public website. Yeah. But what they do have is over $1 billion in cash reserves, right? And a lot of these cash reserves comes from equity investments, people buying up the shares, and loans that they've taken out against the value of the shares as well. Because for whatever reason, Zero is such a stock market darling that it keeps going up in value. So mhm.
That is really fascinating. I have
It's
a quick
fascinating.
I
Yeah.
have a quick question for you just around paying yourself as a business owner. So when times are lean, like should you always pay yourself? Should you always
That's
make
a
sure you
that's a good question.
yeah.
And if you have it on Digital Boost, you can take a look at one of my earlier videos on pay yourself.
Mhm.
There's literally a video called Pay Yourself, and that talks more about strategies on how to pay yourself from the business. But the short answer is that if there ain't no money in the business, then I'm sorry, but you don't get to pay yourself.
Mm,
Yeah.
great.
And you certainly don't want to go into overdraft just so
Mhm.
that you can continue paying yourself, right? But we'll talk more about that later in today's
Okay.
slides as well. Mhm.
Thank you. Yeah.
All right. So that's the main difference between profit and cash. Are there like any questions before we move on? Okay. All right. Cool. All right, so now let's talk about non-taxable cash items, all right? So here are a few examples of things that we would be spending on in the business, but perhaps don't realize that it doesn't actually affect profit. Okay, so first of all, we've got loans, right? Any cash received from a loan is non-taxable. Next, we've got drawings, right? You take money out of the business for yourself. These are similarly non-taxable, okay? And similarly, any cash you put into the business is non-taxable as well, all right? Then we got fixed assets. Now you can't claim the purchase value of a fixed asset as a tax deductible expense, but you still have to pay the cash for it though, right? So if you buy a car worth worth $30,000, all right, that does not count as an expense. Right? I've had a lot of clients ask me, hey Sam, I just spent 50K on this ute for the business. Can I claim it as an expense? I'm like, well, no, actually you can't. Right? What you can do is you can claim depreciation on the asset. Okay, now depreciation is tax deductible, but it's usually calculated as a percentage of the value of the asset over a number of years. Okay, so it's not fully deductible in the first year. Now over here in Aotearoa, um, the IRD has said that any fixed asset worth less than $1,000 is fully expensable within the year it's acquired. So we call these, in accounting lingo, we call these minor asset expenses, right? Anything above $1,000 has to be capitalized and depreciated. Okay, so hence why we usually advise our clients, if you're buying like say a bulk order of furniture, right? Get them broken down into separate line items, uh, all of which are $1,000, less than $1,000 each, and then you can actually claim each one of them during the financial year, as opposed to having to depreciate them all together as like one fixed asset.
Oh, that is really smart. And so in that way, so business equipment, let's say, like, would you say, okay, if you're getting a printer, look at a printer under $1,000,
Exactly. Yep.
phones under $1,000.
Hmm.
Yeah. Okay.
Yep.
Yeah, that's
Absolutely. Yeah. So because like if you got like a $2,000 phone, right, you'd only be able to claim 67% of it in the first year and then the remainder in the second year, right? But if you got it something less than $1,000, right? Not only are you spending less, but you can basically claim the entire amount upfront. Mhm.
Great. You're not going to
Yeah.
get a car under $1,000 or a ute under $1,000, unfortunately.
Unlikely, but back during the good old days, the good old post-COVID days, the IRD actually bumped up the limit to $5,000. So that was the year I told lots of our clients, like, now's the time to buy that van, now's the time to buy that chiller, now's the time to buy all those expensive fixed assets. Yeah.
Yeah.
But yeah, all right. Okay, so let's take a look at the difference between a profit and loss and a cash flow statement, right? Now, I'm not sure if that's big enough. I'll see if I can zoom in. Okay, I can't zoom in. View. Okay, no, I can't zoom in. I can't zoom in screen sharing mode. Sorry, in presentation mode. Okay, right. So can you guys see it? Is it clear enough?
It's tiny on my
It's
screen, but
tiny. Okay, let's see if I can. Hang on a minute. I'll see if I can exit out of here, and then I can zoom in. There we go.
oh yeah, much better. Great. Thank
Okay.
you. Mhm.
All right, so let's take a look at the profit and loss statement. Okay, so profit and loss statement is really simple. You've got your sales, right? You minus off your expenses, right? Then you get your profit. Okay, so here's a really good example. We're actually making a loss because, oh, look at that. Look at how much we spent. Okay, now cash flows is a bit different. Okay, so we've got the cash that we're receiving from our customers, right? Now you'll see that that's kind of almost similar to our trading income. The main reason why it's different is because this figure includes GST, right? And then we've got payments to suppliers and employers, which sort of makes up all of this, right? And then we've also got historical adjustments from like funds brought in at the start of the business, okay? Right, and then we can see that our net change in cash is only negative 800, even though we made a loss of negative 3,000, right? See, because profit and cash flow are calculated differently simply because we're looking at different things, okay? So if you're trying to manage your cash flow, if you're trying to wonder, shit, I'm running out of money, I need to take a look at my P&L, then you're looking at the wrong place, buddy, all right? You need to be looking at the cash flow statement, okay? All right, cool. Now let's take a look at the next slide. Right. Okay, so finally, we're gonna come to the next section. We're gonna look about cash flow visibility, right? So basically, unwatched cash is disappearing cash. Okay, you want to keep an eye on that cash flow. We'll see what's going on with it. Okay. Right. So you might want to take notes. How do we get cash flow visibility? Right. So let's have a little bit of an exercise. I can see we've got at least 6 participants. Woohoo! And I think 2 of them are me and Georgia. Let's see. Yeah.
Yeah.
Yeah, we got 4 attendees. Hooray! All right. Hey, Richard. Richard's here. Okay. All right, cool. Right. So just well, I'll pose a question to the audience. Okay, so if everyone can contribute, give me one example of one of your largest monthly outgoings for your business.
I'll wait and see if anything comes up.
Okay.
Accounting fees. Yeah. Richard.
Sounds like Richard.
Accounting fees, exclamation point.
Yeah. Of course you'd say that.
Mine's going to be room hire, like a
Room
hiring
hire,
space.
rent. Yep.
Yeah,
Yep.
rent.
Okay.
Mhm.
Yeah. Let's see.
Yeah, rent
Yeah.
and landlord
Rent and landlord
outgoings.
outgoings. Yep.
Mhm.
Yep. Anyone else? We've got
Let me
yeah,
check
we've
the
got
socials.
Scott and Sonia. Yeah.
Wages.
Wages. Yep.
Mhm.
Yep.
Let's see if anyone else has anything. Probably supplies for some people, I would
Yeah.
guess. I'm thinking about you,
Purchases.
Sonia. I know Sonia's business, but
Mhm.
and it's fairly new, but if you were up and running full,
Okay. Yeah.
Sonia. Yeah,
Okay.
I'm not trading, don't have monthly outgoings yet, but
Yeah, I
when
can.
you do, Sonia, your
Yeah.
supplies are going to be big. I'm telling you,
Okay.
Sonia. I'm telling you what your business is going to be.
Sounds like you need an accountant, Sonia. Wink. So you can pay us lots of money too. Right. Anyway, cool. So based on what we've seen in our client books, these are usually our four largest monthly outgoings. Okay. Right. Wages can easily make up to 50% of your monthly outgoings, sometimes even more. Right. If you got staff, if you're a solopreneur, you don't have to worry about this too much. But your wages will be replaced by your drawings essentially. Okay.
Mhm.
Rent. Okay. Right. Subscriptions. Okay, so this is subscriptions to your Microsoft 365, your Google Workspaces, Adobe Acrobat, your Salesforce, or whatever other CRM software that you use, right? And franchise fees. Okay, so if you're running a franchise, you often have to pay stupid amounts to your franchise owner for the right of using their branding, their logo, or accessing their network of contacts and all that. Yeah. Internet hosting, consulting fees. Yep. Yep. Except that consulting fees typically, and internet hosting typically tends to be an annual fee. And consulting fees typically you'd only pay them out when you need to engage a consultant, not not usually on a monthly outgoing basis, unless you've got a business coach who charges you $2,000 a month for business coaching. Yeah. Right. So the first step to cash flow visibility is to identify what your four largest monthly outgoings are. Okay. And you can usually quite easily do this by pulling up your cash flow statement, right? In Zero, for example. But later on, we're going to demo a really, really cool cash flow software that we use with our clients to basically get better visibility over the cash flow, right? And so first of all, we take a look at those four largest monthly outgoings. So if you can identify what they are, and if you know what they are right now, you can scribble it down on a piece of paper and just put how much are you spending on wages each month, how much are you spending on rent each month, and how much are you spending on the subscriptions and or franchise fees each month. Okay. And so that gives you kind of like a baseline, right? So if you are spending like 3,000 on wages, okay, and 2,000 on rent, and another 200 on subs, right? So that's about 5,200 already each month. That's outgoing, okay? And so that means that you need to find ways to cover that 5,200 each month, right?
Yeah. And Scott is saying here in the Q&A, I'm guessing these depend on industry. In hospo, cost of goods is second to wages.
Yep, you're absolutely right. It does depend on industry. The only reason why I didn't put cost of goods in the four largest monthly outgoings is because for service-oriented businesses, obviously cost of goods is not an issue for us because we don't have to buy material. And for the most part, cost of goods is known in accounting terms as a variable cost. It's variable because it goes up with the amount of sales that you're making, right? So invariably, right, your sales is supposed to cover your purchases, right? Because your purchases are based on the amount of sales. So, but if you're buying more than what you're actually selling, then you should probably look at buying less. Yeah.
And you're also
Had a
pricing it around what you're purchasing. So if you're
Exactly.
selling, you're making that extra, that profit that goes into,
Absolutely.
I don't know if profit's
Absolutely.
the correct word, but the extra that goes
The
into your
surplus. The surplus
surplus.
would be,
Thank you.
yeah.
Thank you.
Yes. We use surplus when we're referring to profit that is, not necessarily taxable. Yeah.
Great.
Yeah. I was having a really, really great discussion with one of my retail clients yesterday about how they had to manage and focus their buying strategy. Yeah. Because they were making heaps of sales, but then they were buying too much stock. And so I was like, look, mate, you can't keep buying this much stock, You've got to manage it better. And so, yeah, we worked out a strategy on how to basically buy stuff while still keeping the business in the green. Right. So next, after identifying your four largest outflows, we'll take a look at your average monthly inflow. Okay. Now, on average, how much cash are your clients paying you each month? Can you reliably forecast what will come in the next month? Okay. Now, I think that most business owners will have a gut feel about this. in most cases, right? If you were to ask me right now, okay, hey Sam, how much do you think you'll be making next month? I can give you a precise figure, with a 10 or to 20% margin of error, right? I know exactly how much money is coming to the business. But if you are not sure, again, you can always go back to that cash flow statement, right? Take a look at what your historicals are looking like, right? And then that gives you a better idea, okay? But for the most part, if you know that you're billing $10,000 worth of sale last month, right? And maybe next month you've got about maybe 8,000 in the pipeline, then you can use that as an estimate, right? Of what's coming in.
So, Sam, if you
Yeah.
are a seasonal business, like a lot of
Mhm.
businesses in Aotearoa
Mhm.
are, would you look at the historical of your, and your lean times and your
Yep,
seasonal
you
times? Is
definitely
that how
would.
you?
You
Yeah.
definitely would. So we've got a client who sells furniture based up in Auckland. And so they've also noticed that their sales are quite seasonal as well. And same with the retail client I was speaking about earlier. So now, obviously, when you're coming towards the Christmas period, sales increase. This client that I was helping yesterday actually sells like Magic the Gathering cards and D&D stuff. And so they actually had a surge in sales over Father's Day because lots of like geeky millennial dads out there, like myself. So yeah, it's good to be able to plan around these seasonal variations as well, right? And later on, I'll show you how you can leverage on software in order to be able to build out those historical forecasts better, right?
Great.
Yeah. So, but what I'm talking about here is just kind of like general, if you want to grab out a notepad and scribble it down in notepad right now, here's what you can do. So then once you've established your outflows, establish what your inflow is looking like. Okay. Right. And then that will give you essentially what your net cash flow is at the end of the month. Okay. So using the previous example, let's say our cash inflow is, we think we're going to make 7K worth of sales, right? But then we're going to spend 5.2K. So that means our cash inflow is 1,800. Okay. So that is the cash that is left over in our business. Okay. Now, obviously, if our cash inflow is going to be less than a cash outflow, then we've got a problem. Then we've got to figure out, okay, how are we going to cover that cash shortfall? Do I put money into the business? Do I take a loan, right? Do I beg my suppliers for better credit terms, etc., etc.? Okay. Right. So once we've established what our baseline is looking like, how our inflow versus outflows look like, we're going to take a look at working capital hacks. All right. So working capital here talks about how to maximize the amount of time, to minimize the amount of time to get cash back into your business. Okay. So let's tune up your working capital. Right. So the first thing that we can do is to chase up your accounts receivable, right? So for clients, so for those of you who have clients that you bill on an invoice basis, right? It's very, very important to chase up those invoices because you've already done the work, you've already sent out the bills, and so your clients better bloody pay up. And I say this, as an accountant, we do a lot of business on an invoice basis. And so over the years, these are some of the strategies that we've come up with, right? So first of all, we want to identify invoices that are more than 90 days old. Okay. And if you're using Xero, this is really easy to do. You just have to go to your, I'll open up demo company here. So you just have to go up to the accounting, your age receivable summary, okay? And then you can actually look at what is old, right? You can see how old your invoices are, right? And generally speaking, for me anyway, if it's more than a month old, right, then it's time to do something about it, okay? Next is to send them a polite but strongly worded email. Okay. If that doesn't work, pick up the phone and call them directly. You want to Yeah. Most people will pay up by this stage. Most people, most decent people will pay up by this stage, right? Okay. Right. If they're still not paying up, okay, then you bring in the penalties. All right. Okay. And number five, last resort, yeah, seek the lawyers on them. Right. Or you can engage your debt collectors to act on your behalf. Now, usually when it comes to step number five, I usually like to think about the size of the invoice as well. If it's like a few $100s and they're not paying up, I'm just happy to write it off. Okay. And it will count as an expense in the business, which is great because that's tax deductible. Okay. But if it's like a significant amount, so like five figures or above, then yes, I would probably stick the lawyers on them, get the debt collectors involved and all that. Right. But accounts receivable is important. Why is it important? Because it's great to have $10,000 worth of sales on your profit and loss account, right? But because remember, profits are calculated on an accruals basis. If the client isn't paying up for the amounts that you bill them, then you're going to end up paying taxes on cash that you haven't even received yet, you see? Right? Okay, next is to negotiate with account payables. So you know how you're getting your customers to pay you up faster? Well, on the opposite side of things, you're trying to negotiate with your suppliers to say, hey, please, can you extend my credit terms? Okay. Right.
So the tables are turned here,
The tables
Sam.
are turned here. The tables are turned.
Yeah.
And the first thing when dealing with suppliers is that number one, you want to be honest. All right. Let them know, say, hello there, supplier person. My cash flow is hard. I may not be able to pay your invoice. Can I say pay using installments, right? Or can I finance it? Can you extend it over a period of time? I'll pay the interest on it or whatever. Okay. And you'll notice that these are also the same strategies that you can use with the IRD as well, which we'll talk a bit more when we talk about staying on top of your taxes. Okay. Right. And next one is reduce purchasing. Okay, so this is really relevant for business owners who have stock to manage, who have stock and raw material to manage. Okay, if you're selling less, then well, you got to spend less. Yeah, right. If you're forecasting sales to go down, then don't buy so much stock. So for retail, hospitality, and construction, purchases need to be timed correctly to coincide with sales. So it's important to correctly forecast sales so that the correct amount of purchases are made. Okay. Right. So when making purchases, consider the following. Like, what are your sales looking like over the next 6 weeks? Okay. And generally, if you've been in business for like a year or more, you'll have a good idea of what your sales will look like over the next 6 weeks or so. Right. So obviously don't buy more than what you're going to sell. Right. And be careful about locking into purchasing contracts with suppliers. Right now, this is a lesson that I've learned from this client that sells gaming stuff, and so they got locked in with a contract to buy trading cards from a certain brand of trading card games, and it turns out that people didn't want to buy that particular brand of trading cards, and so now they're stuck with a whole lot of stock, and they still got to buy out. Still got to follow their purchasing contract to the end. So be wary, really be wary of locking yourself into those sort of contracts. Okay. Next is, do you have leftover stock from previous purchasing runs? So if you've got old stock, I mean, it sounds like it makes a lot of sense, right? Just sell it off at discounted prices, but you'd be surprised how few retailers actually do that. Because it takes time to analyze your stock levels, take a look at what the old stock is, and then put out the promotions to sell that stock. Right. But ultimately, if stock hasn't moved for more than a year, you want to put it on sale. If you are in hospital business, obviously raw material, raw ingredients have to be used up before their due date. Then you need to have more efficient kitchen processes whereby all the ingredients get used up before the fresher stuff does. Yeah. Or you need to have a strategy in place in what you're going to do with ingredients past their due date. Right?
It's interesting that you mentioned hospital because I know, Scott's on here too and has a commercial distillery. And not to call you out, Scott, but thinking about like when you go forward in trying to figure out, okay, projecting what are our sales going to be, especially for hospo in an economic downturn, like that's really hard
Mm.
to figure out, right? Like how would you suggest that people actually can see the future?
I've actually the answer to those questions, and they will be answered later in the later part of this
Oh,
presentation.
good.
Yeah,
See, I'm jumping the gun here. All right, I'll
yeah,
let you
yeah.
keep
That's all
going.
right. Like,
Okay.
really, really good question. I
Mm.
mean, because we obviously can't see the future, but then we can sort of model the future. All right. Okay. And finally is reducing team spend. Now, I'm not a big fan of reducing team spend. I have always believed that your team is your business. And if you're letting valuable team members go, then you're just going to be hurting the business in the long run. But sometimes, let's say you squeezed your customers all you can, you've gotten as much credit as you can from your suppliers, and you reduce your purchasing all you can, then unfortunately, you may have to look at reducing team spend. Okay. So when you're reducing team spend, the first person to go are the contractors. I'm sorry, guys. I'm sorry, Georgia. But yeah, if you're a contractor, you're always the first on the chopping block because contractors are only called on when there is work to do. If there's no work for you, then there's no work for them. Easy, right? Okay, next, our fixed term employees. Okay, if you can't afford to extend the contract with fixed term employees, you don't have to. All right, but then you lose out the investments that you've already made in them. All right, okay. Next is part time employees. First, I would recommend seeing if they're willing to do reduced hours before letting them go entirely. Okay, right. And obviously, again, just like with your suppliers, be honest about what you can afford. And then full-time employees are the absolute last group that you want to avoid cutting out, okay? Because these are the core of your business operations, right? This is like your last option, right? And remember that if you're starting to cut your full-time employees, that could affect your ability to bounce back when things are better, right? So be very, very careful about that. This is your absolute last resort after you've done everything else to keep the business afloat, right? Only then do you look at cutting your full-time employees because they're there for a reason, right? And so you don't want to be cutting them off. Okay. And so from there, you can work out your working capital. You can add the average days it takes for a customer to pay you, minus the average days for you to pay a supplier, add the average inventory holding period, how long it takes for you to sell stock from the point of buying it, okay, and minus the average days it takes for you to pay your team. And the total equals the number of days you need a cash reserve for. So, for example, let's say it takes a customer 30 days to pay you, right? And it takes you about 15 days to pay a supplier, okay, right? And then it takes you about 25 days to sell inventory, okay? And you pay your team really, really quickly. You pay them within the week. It takes you only 7 days. Okay. So this number, which we've come up here with 33, this is the number of days you need a cash reserve for. Okay. So this means that you have to look at what is your average spending over that 33 days. And that is the amount of cash that you need to have sitting inside your bank account. Okay. All right. So that's how it works in theory. Like in practice, obviously every business is different, but this is a great starting point to take a look at what your working capital is. And so obviously, if you can get your customers to pay faster, if you can get your suppliers to extend your credit, if you can sell your stock faster, right? If you pay your team less frequently, then you can reduce your working capital, right? So you can reduce the amount of cash that you need to hold inside the business, right? So which means that you can have cash available to spend on other things, okay? Or to retain within the business, or to keep for a rainy day, etc., etc. Okay, all right, all right. Any questions about working capital? Hope that
Nope.
wasn't too technical. I mean, that's basically like half a semester's worth of like
I love a
accounting theory
formula.
there.
Give me a formula all day long.
Yeah,
Absolutely. Tell me how to
yeah.
do it step by step. Love it.
Okay, all right. Okay, Number four, we're going to talk about staying on top of taxes, okay? Because taxes are important, okay? And even though your cash flow is not so good, you may have to still pay taxes because of the reasons that we pointed out earlier when we were talking about profit versus cash, okay? You want to keep the tax person off your back. Right, so first of all, you want to have separate bank accounts. Now, if you can, I do believe there was, I think it was in the same pay yourself lesson that I did for Digital Boost. We talked about having separate bank accounts for tax, right? So always have a separate bank account for taxes and don't touch your money in the tax account. That is for taxes, don't touch it, okay? And ideally, you should have a separate GST and income tax account if you are GST registered, all right? Okay, so how do you put aside money for taxes? Number one, before you take any drawings from the business, pull up your P&L for the current year. Ensure that you have at least 28% of that amount in your income tax savings account. So if you're using zero, what we would do is we would just go to accounting, P&L, and then we would look at this financial year. Okay, and then we take a look at that profit. All right, so say that profit is 13K, and then times 28%. So we want to have $3,000 sitting in our income tax account at that moment. If you only have $2,000 sitting in your income tax account, then you find that $1,006 to top it up to 3,600. Okay. Right. Next, you can run a preview of your current GST period in your accounting software. So again, using zero as an example, you can go to accounting, GST return, and you can click on, yeah, sorry, I need to, woo. Okay. All right. And then you can click on in progress here. You can click on it, and then it shows you how much GST you have to pay. All right. So obviously this demo company apparently isn't GST registered. Right. But that amount there will show you how much GST you have left to pay. Okay. Right. And you need to have that amount sitting inside your GST account. Okay. So once money has been set aside for taxes, consider how much money you need in your account to pay upcoming bills. Okay. Right. So remember we talked about your monthly cash inflow and sorry, your monthly cash outflow, right? Okay. And then we also talked about our working capital. So if you take the estimated amount of money from your monthly cash inflow minus your outflow, right? So that gives you a baseline of what you're going to have at the end of the month, right? And then minus that from what you are going to be spending over that working capital period. And that is the amount of money that you need to have in your accounts. Okay. So let's say that you're going to end up with, so you say you spend about, you're going to be needing about, say, 5,000, right? Over that 30-day period. Okay. And we can minus 1,800, right? So that means we want to ensure we've got at least 3,200 sitting in the accounts as at the bare minimum. Okay. So that we don't get caught short, right? Bearing in mind, obviously, if there are any big bills coming out, you want to make sure that you've got money set aside for those big bills as well. Okay. Number four, if there's any leftover funds, then you can use that to pay yourself via drawings. If there are no leftover funds, then I'm sorry, but you don't get to pay yourself. Such is the life of a business owner. Yeah. Okay. And finally, you got to remember when your tax due dates are. Make sure your tax is paid on time. And if you've got a great accountant, they will remind you when these are due, right? And we always make it a point to remind our clients to pay up the taxes if they haven't. Okay. Now, GST and income tax tips. Here's some quick and easy income tax tips that you can take advantage of immediately. Right. Some business owners forget they can claim things back like home office expenses. Okay. Always claim back your home office expense. If you are using a portion of your home for business-related purposes, claim the home office expense. Okay. Number two, interest paid on loans. People forget that when they pay off their loans, interest is tax deductible. Even if the principal portion is not tax deductible, interest always is. Interest paid to the IRD. If you're late on paying your taxes, IRD will charge you an interest expense. These are tax deductible. It's kind of weird, right? Money that you pay to the IRD is tax deductible, but that's how it is. Okay. Right? You can't deduct penalties, by the way, but you can deduct interest. Okay. And various type of business insurances. Okay. Income protection insurance is tax deductible. Business professional indemnity insurance is tax deductible. Your ACC bills are tax deductible, right? Okay, make sure to make these claims in your income tax return, otherwise you're going to be paying more taxes. Now, a lot of GST registered business also miss out on claiming the following. GST on import duties, really important if you're importing goods from overseas, okay? For anything that you import over $1,000 gets a GST levy on it. Now, you've got to pay this money to the authorities, but if you're GST registered, you can claim 100% of those import duties back, okay? These are 100% GST refundable. I've seen a lot of clients forget to claim them, and then they've got like thousands of dollars, sitting in credit with the IRD. Okay, so you want to claim these back, right? GST and purchases from big MNCs. So most of what we know about GST, so your average layperson will know that you don't claim GST on overseas purchases, right? However, overseas companies that have sales of more than 60K in Aotearoa actually are GST registered, okay? Which means you can claim back the GST on purchases made from them, right? So generally speaking, if you're paying Facebook, Google, Microsoft, Apple, they will very likely have more than 60K worth of sales in Aotearoa. So you want to be claiming back the GST on any payments made towards them, okay? And I've seen a lot of clients who miss out on claiming this GST because they weren't aware that actually GST does apply to some overseas companies. Okay, right. Okay, so finally, we've come to forecasting cash flows. So now let's take everything that we've learned, right? And let's take a look at how we forecast cash flows. Okay, so to start off with, you need a baseline forecast, right? The baseline forecast should reflect your monthly cash in and outflow. Right, baseline forecast is built using actual monthly averages. Now, if you're using zero, okay, you can actually go to your cash flow report. It's under accounting reports, and then you can click your statement of cash flow direct method. Okay. And then you can compare this with like last few months, right? And then you can work out the average of this, right? And then you can export it as an Excel and you can work out the average of this. But that's so 2019, man, right? So these days, what I do for my clients is I use a software called Budgie, right? Budgie is a really awesome software. It's being developed right here in the Waikato. Yeah. Shout out to Richard Cross, who's watching us today. Developer and founder of Budgie. All right. And
little plug for Richard. There you go.
Right. So Budgie is really cool because it's really quick and easy to set up baseline forecasts. So if I'm, say, looking at September here, and I can just click that button to forecast it in the future, and I can choose the average of the last 12 months, 6 months, or 3 months, right? And so that how you want to set your baseline depends on what you think is most realistic, okay? Is it realistic that you're going to be making 48K worth of sales into the future? Or is it more realistic that you're going to be making 50K worth of sales, right? And so often when we have our virtual CFO catch-ups with our clients, we sort of like sit down with them and we discuss what's the most reasonable figure, okay? So if we go for last 12 months, then that gets pushed forwards into the next few months as forecasts, as you can see that. So I've already set up all the baseline forecasts for this particular demo company already. But when you start off for the first time, you're going to have to do the forecast themselves, right? And look, by the end of the day, like you're welcome to use whatever cash flow forecasting software that you like. I just happen to really like Budgie. But if you're invested in Float or Futurely or one of the other softwares out there, then yeah, you should be able to do the same, right? So first is to set your baseline forecasts. And so you can do that by calculating the average of your figures over the last 3, 6, or 12 months. Okay. And you can do the same for expenses as well. So for purchases, we can say that, yep, we can take the last 12 months for that. All right. And for advertising, maybe we want to take the last 3-month average. Oh, okay. That's okay. Well, that's a little bit awkward, but yeah. And wages and salaries, we can also push this forwards for the next 12 months, right? For example. So in doing so, that gives us a baseline that we can project into the future. And that gives us a good idea of what our cash flow is going to look like. Okay. So that's the first thing to do. Second thing is to start building scenarios to test your resilience. So now here's where things get really cool. Okay. So remember, Georgia, how you were saying about, how do we forecast the future? How do we know if things are going to get better or going to get worse? Well, the answer is you don't. You don't, right? If we did, then I wouldn't have to set up an accounting firm to make a living. I just go to the horse races and pick the winning horse all the time. Right? But because you can't predict the future, right? But what we can do is we can make an educated guess about what the future is going to look like, right? And that's where we build out scenarios. Okay. So let's take a look at the first scenario: reduce sales. What does your cash flow look like with the sales reduction? Okay. And so in Baji, what we can do is that we can actually create, if you'll take a look here, right, on the left-hand side of the screen, we've got something called a scenario creator. Okay. And so you can actually create scenarios for Baji that decreases certain categories by certain percentage on certain dates. Okay. And if I were to have reduced sales, how is that going to look like? Okay. You can look at on the cash summary, you can see it going down here. But more importantly, you can look at it on the dashboard. Okay. So if I uncheck this box, our sales are up here. Okay. And then we are sort of like just barely skirting through. But if our sales go down by 20%, right? Oof. Okay. Then it shows that by January, we're going to run out of money.
Wow, this is amazing. I didn't expect to get a budgie demo, but this is fun.
Oh, I mean,
Sam.
I think it's hard to have a discussion about cash flow management without having the correct software to
Well,
manage it.
that's the thing, right? With Digital Boost, we're talking about digital tools that we can use. So this is actually fascinating and gets us there faster than trying to do the maths, analog, which is like my go-to.
Yeah. Yeah.
Not anymore. I've learned a lot, people. But yeah.
Yeah.
No, I love
So
this. So yeah,
so
continue.
basically this tells us that unless we do something about it, we're gonna lose our cash by January if we're predicting a 20% decrease. Okay. Right. So maybe you want to say like, okay, cool. If we get in 50K worth of financing in December, that will bump us up, right? To cover the sales decrease. So that would be the next scenario that we're looking at, getting finance. Maybe you need to take out a loan, all right? Maybe you need to sell some equity in the business. How much money are you bringing in, right? So let's say our sales are dropping by 20%, but okay, we're going to finance it with 100K finance, right? Which, sorry, that did I do this correctly? Incoming, okay, on the September. All right, because we're in September right now. Okay, we'll make this due on the 15th of October. Yeah. All right. Okay. So maybe we've got maybe we can bring in some financing to help with that, right? Okay. And so that helps to cover our sales decrease. So we get to survive for a bit more, right? But we've also got our loan repayments to remember to do as well. All right. And so that's going to trigger with a loan, right? Okay. But let's say what if we don't want to take a loan, right? And our sales are going down. What if we downsize, right? If we downsized and we're going to estimate a 15% decrease in our sales, but we're going to decrease our wages and salaries by 30%, and 15% for all our sales products. What's that going to look like? All right. Okay, so it looks like, okay, we're doing slightly better. Okay, right. We're kind of still just surviving, but yeah. Okay. And so yeah, and so that's what we're talking about, scenario building, right? And so usually what we would do with our clients, that we sit down, we work out scenarios, right, on what's the best course of action for them, right? Some other courses of action that you can look at can also be things like maybe hiring more staff. Your business is growing. Can you afford to hire more staff, right? Buy more fixed assets. Okay, you need to make investments in growing your business, right? Maybe you want more fixed assets. Okay, starting a new income stream. All right, maybe instead of just selling fried chicken, maybe you need to start selling burgers as well. Okay, all right, and tax planning. Okay, so often we've got a lot of clients coming to us with huge amounts of tax debts. And then so we can also use Budgie as well as a means of planning when to pay those taxes. So we could even like create a scenario, right, for tax, for income tax. Okay, and we can say, all right, what's the due date for this tax? All right. And let's say the due date is on the 20th of October. Okay. And we've got provisional tax to pay of say 10K. Okay, based on our current assumptions, are we going to be able to afford paying that in October? I mean, we can, but we're going to be like 10K, 10K cash outflow, 10K out of the pocket. Okay, so if you don't want to have it paid lump sum, what if we do it repeating? What if we do an installment arrangement of $1,000 a week? Okay, repeats every 1 week. All right, on a Monday, right, ending after say 10 repetitions. Okay, and then we can update that. And how's that going to look? Okay, so now that's starting to look a little bit better for our cash flow. You see? So yeah. So the important thing about cash flow management is that you obviously, want to check the forecast regularly. Okay, and take a look at your cash balances at least once a month. At least once a month, you want to take a look at these things, right? Okay, right, cool. And really, that's about it. That's all I got for you today. Looks like we're almost out of time. We've got 2 more minutes left for any Q&A. Yep.
Yeah, this has been great. If anyone has questions while we're finishing up here, just pop them in here. But I also want to ask you, Sam, if anyone wants to get in touch with you, what is the easiest way for them to contact you? Would that be on LinkedIn or your
so
email?
LinkedIn would be great. You can find me on LinkedIn. You can also send me an email on, hang on a minute. Let me just exit the slideshow. And you can also send me an email on sam@samharith.com or sam@shadvisory.co.nz. Yeah. So sam@shadvisory.co.nz. Okay. Right. And yeah, happy to talk about finances with you guys
And
at
then
any time. Yeah.
and for Budgie, the Budgie app, I'm just curious because I was trying to pull up a link for it to share it with everyone.
So yeah,
Spell it out for me.
live.budge.ee. So I can put it in the chat for
pop it in the
everyone.
chat. Yeah.
So live.budge.ee. I hope I'm getting this right, Richard. Yeah.
Live.
So Budgie's really cool. I highly recommend for anyone who wants to get on top of their cash flow to check it out. And if you guys need help with Budgie, just give me a call. Happy to walk through it with you for free even.
I think it's great. And it's one of those things that if I wasn't already booked up for the year with events, Richard, I would have you come in and share this with us. But who knows, maybe 2025. Who knows? Live.bud. Okay. Got it.
Live.budge.e.
Okay. Great. And then another thing I wanted to share with you, actually with you, Sam, and with everyone watching, If you missed our, we had an event with Taxi, and Taxi is a company that is helping profitable businesses in Aotearoa use their provisional tax to infuse cash flow into their business at a really, so that you're not paying an exorbitant amount to the banks. They're doing it for a very, very small
Mhm.
fee. I don't know if you've heard of it, Sam, but it's great when we're
Yes, I
talking.
have heard of Taxi because
Yeah.
I've worked with their parent company, Tax Traders.
Yes. Okay,
Yeah,
great.
so yeah, we've got quite a few clients using their tax pooling services. Yeah, but I think it's worth pointing out that it only works if you have got a provisional tax credit balance built up.
That's
And so
right.
not all businesses pay provisional tax. And if you're not quite sure if you are paying provisional tax or not, I suggest having a chat with your accountant. Yeah.
Yeah. Yeah, great. Oh, this has been wonderful. Thank you, Sam. As always, it's great to have you here, and it's great to have you walk us through these scenarios with
Mhm.
such in a way that it's really digestible. I love, well, Sam used to be a teacher, which I always love to point out because look at this, look at the presentation and how it comes across. It's fantastic. Sonia saying, this has been terrific. Thanks, Sam. Yeah,
Thank
thank you,
you, Sonia.
Sonia.
You're welcome.
Yeah, and
Yeah.
thank you everybody who's here every week. And love seeing you all. I will see you Thursday. We're going over Microsoft on Thursday, so it's just a workshop if you want to pop in and see what's happening in the AI world there. I'll be there. Sam, thanks so much. So good to see you. Have a great day, everyone. Matewa.
Matewa, kakite.